Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis on Monday, November 24, 2014. It's Thanksgiving week. We normally see light volume throughout the week. You're looking at, well, I'm going to switch over. You're looking at a weekly chart of the SPY. Let's go over to a daily chart. And what you had here is what's called an inside day. An inside day means that the high and low of today was inside the high and low from the previous trading day, which was Friday, and it doesn't mean much. It's just an inside day, and as a result of the light volume, you didn't have much movement. You had a little bit upside in the S&P. S&P was up just short of 6 points. The Dow was up just short of 8 points. But the Nasdaq performed well. It was up 42 points. And the IWM, or the Russell Small Cap Index, was up nicely, about 1% today. But all in all, you normally would have a light volume trading week throughout the week, and it would actually get increasingly light volume, or should I say decreasing volume, throughout the week. However, there is, I work with cycles, and on a short-term basis, my short-term cycle is coming up with a down day for tomorrow, and normally I would expect a down day for tomorrow, but with the light volume, with Thanksgiving, I'm not really sure, but nevertheless, the cycle says a down day, so I'm telling you there's a down day expected, and we'll see how that plays out. Because of the light volume trading week for Thanksgiving, I wouldn't normally take a position, or I didn't take a position one way or the other. I'm just letting you know that I'm expecting a down day for tomorrow if the cycle should play out as it normally does. If not, then you'll probably have another float day, on Wednesday and Friday, and then that closes out the week, and then we'll get into December. And after December, after December begins, I would expect the correction to begin. I would expect the correction to first take hold and get us down to about the 200 level in the SPY, which would coincide right around the 2,000 level in the S&P, and then if we went further than that, I would look for right now, because of this rising 50-day moving average and the rising 20-day moving average, I know my target keeps moving up, but that's because the moving averages are rising as the market's rising. So right now, on the downside, my maximum downside I would expect would be about 198 right now, 198.5. And we'll see how that takes hold after the 1st of December rolls around. How long would that correction last? Well, maybe about 6 or 7 trading days. That's typically a corrective position, or a corrective amount of time. We've gone up for a little over a month. I would expect about 25 to 35% of that to be corrected. So you figure anywhere from 6, 7, maybe as much as 9 trading days. That would be, if you're a Fibonacci person, that would be either 25% retracement of time, or maybe a 382 retracement or close to it of time. Not necessarily price, but time. So time is more important than price, always. So that's about all I have for the S&P. There's really not much going on. Half the stocks are up in the half the momentum stocks are up, half the momentum stocks are down. There's really not much to discuss tonight, further to discuss tonight on the major market, only because of the light volume. There's just market's in this basically the same position it was on Friday. Let's go over to the gold market. There is a little bit to discuss there. And if I can get the chart going, let's see. Okay, so here's the GLD. And if we can get a little bit of momentum on the upside, today was pretty much a flat day in gold. The GLD was down 28 cents, but that's flat on a $115 price of the GLD. But if we can get a little bit of momentum, I think we can get up to this 118 area first, and then the 120 to 120 and a half area second, before we put in a correction in gold, and then maybe we see what kind of pattern it creates, and then it'll tell us what to do next. But right now I'm looking for some upside in gold, and I think that would pull the gold miners with it. So it would pull GDX along, which is a basket of gold miners, an ETF. And I do think there's some upside in gold. Why is there upside in gold? Well, I don't tie gold to the market, and you'll hear the talking heads and the pundits on TV do that, but I don't like to do that. I like to tie gold to its own market. However, there is one outlier, which is inflation. And I've talked about that over the last several videos. And the reason I say that is because when you look at what the central bank in Japan is doing, and you look at the central bank in Europe, or the ECB is doing, they're buying securities, they're buying bonds, they're buying equities. Well, Japan is buying equities. Europe right now is buying asset-backed securities, and soon I think they'll even be buying into the equity market. And that being said, they're trying to prop up the markets. They're trying to create an inflation environment, and they're trying to help their economies recover in their terms. But what they're actually trying to do is they're trying to stave off a deflationary environment. Okay, they can create inflation as central banks, but they have a very, very difficult time holding off deflation. Think of deflation as a pool, and a pool with a leak in it, and they just keep having to fill the water up with pool just to keep it even. And that's what's going on right now with the fear of deflation. Deflation is asset deflation prices, or deflating prices. Okay, they don't want real estate to deflate. They don't want stock market prices to deflate. They don't want hard assets to deflate. They don't want wages to deflate. They don't want the entire economy to deflate. They don't want employment to inflate, okay, which would be a deflating workforce. All those are very scary for central banks. They're very scary for governments because, for all the obvious reasons, we saw it in 2008, 2009. That was a deflationary environment. That's what they're trying to stave off. So that's the reason why I believe gold is on the rise, not because gold is in direct proportion to what the central banks are doing, but I think if people believe that the central banks are trying to inflate the markets, they believe that you have to own gold because there's inflation. Therefore, they're going to buy gold. Therefore, if people are buying gold, other people buy gold because they think other people are buying gold. That's basically the way market works. Markets are made up of people, and people do what other people are doing because they're pushing prices in one direction or another. Okay? So we're going to look for higher prices in gold. On the GLD, we're looking for about 118 and then 120, 120 and a half. In the price of spot gold, it's going to translate to, first, my target is about 1225. Right now, we've closed today around 190, roughly 1190. I'm sorry. I think we'll get up to 1225, maybe 1235 on this run, and then should see a pullback from there, maybe even as high as 1245. But we should see a pullback from there, and then we'll see what the pullback looks like, and then we'll decide whether or not gold has further upside. I believe it will into next year, but we have to see what the charts tell us. We always do what the charts tell us to do, right? Not what we think it should do. Okay, so let's go over to the oil market. And there's nothing really going on in the oil market. It's stuck in the mud. 74, 75, 76, we hit 77, and it's just going back and forth. There's no pattern being put in. Even if I look at a longer term to try and get a better picture, a bird's eye view of the market, I don't see anything tradable here. There's just nothing going on. This week, last week, could be a case for trying to put in a low, but until we get above this red candle here from a couple of weeks ago, and the high is 30.17 on the USO, okay, until we get above there, there's really nothing to discuss. There's no trade in crude oil. However, with the market, with my anticipation that the market should pull back after the Thanksgiving holiday week, I am looking at the energy sector because there's so many things in the energy sector that were beaten up so badly when the market pulled back from September into mid-October. And some of them really haven't recovered at all or much at all. And I think if we get another correction in the market, there's a lot of plays out there that'll be ripe for a nice rally. And I'm going to put those out to the members when the time is right. But I think there's some huge gains to be had in the oil energy complex, maybe towards the middle part of December. So stay tuned stay tuned for that. I'm looking forward. I have a laundry list of stuff in the energy sector, and as we see those equities develop, I'm licking my chops for some nice gains in some of those stocks out there. I think that's about it for tonight, folks. Should be a light trading week, except for my cycle day tomorrow, which should produce a down day if the cycle holds true. I don't know that it will, but normally they do. But with the light trading day, it's a little suspect. But we'll see what happens, and we'll review it tomorrow night with you. I'm David Frost, MyStrategicForecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.